Alright, what's up guys? I hope you're doing well. James here from jamesdforsythe.com. So I wanted to start going over the recent Fed Financial Stability Report, and this was published in November, just for kind of reference, November 2022. And mostly I wanted to start off with looking at the general kind of size of these asset markets and various different kinds, right? And so also kind of starting with a little bit of context, but also going into an actual chart that looks at the actual size of the markets, kind of like a generalized market cap in a way, not necessarily like a measure of valuations themselves, just to kind of put a little bit of nuance in there. I know they're obviously related, but it's still want to make that distinction. But also looking at the growth over the past year, and this would be from basically year over year, Q2 2021 to Q2 2022, right? And kind of comparing that to the average annual growth from 1997 to 2022, specifically Q2, obviously, as the year's not over yet. But it's also interesting because there's some insights that I didn't really think of, specifically with related to the size of the asset markets themselves. So that being said, with some general context, so we kind of know how much turmoil there has been the past year or so for markets, and whether or not you think that's over is completely separate topic. Not going into that specifically, just kind of looking in general size so that we can kind of gauge where we kind of are in market cycles and that sort of thing. So basically, we know that yields on long-term treasury securities have risen noticeably. A lot of the time are mostly because of the Fed increasing interest rates and a few other things, right? Beginning, I think they started hiking November of 2021, if I remember correctly, and basically going from essentially zero bound all the way up to mid 4% on some of the short-term treasury bills and that sort of thing. So kind of, I think this is the fastest move in history, I think, in terms of being that the Fed actually hiking rates consistently for such a short period of time, right? Or at least this distance in this amount of time, so to speak, kind of looking at the actual rate itself, but maybe not. Anyways, so along with a diminished risk appetite, this contributed to a decline in broad equity indexes and a widening of corporate credit spreads. And so the valuation measures tracked for most corporate financial assets are now near or below their historical averages. And I'm going to point this out when we get to charts in future videos and such, because they change, or the historical averages change depending on what we're talking about. Sometimes they only go back to 2002, sometimes they go back to 1995, and sometimes earlier, sometimes not. It just seems like it just depends on the asset class itself. So basically, the valuation pressures in real estate remained high, and the national average house prices continued to rise year over year, although recent data show a significant slowdown in growth and falling prices in some geographic locations, right? And keeping in mind that housing is very localized, you can't just you have to take it with a grain of salt when you're looking at the entire U.S. housing market as a whole. That doesn't necessarily mean it's uniform, obviously, because it is very localized. And kind of see this now with a lot of the linear markets are kind of unchanged, but the cyclical ones are tanking rapidly. I don't know if I said tanking. I'm trying to remember the actual term. They are softening significantly, I think, is what I've heard some experts say, specifically with respect to cyclical markets. So like your San Francisco, Seattle, that sort of thing, right? Those types of markets, right? And also one of the interesting points that they arose in this part of the stability report is basically with commercial real estate. And so basically their prices continue to increase since the previous report being May 2022, albeit at a slower pace in recent months, so kind of reflecting the same as other types of real estate, to where they're still growing, just at a slower rate. So kind of following a more disinflationary argument in that respect. And so with both capitalization rates and capitalization spreads, which is the difference between the cap rates and real treasury yields, they're at low levels. So commercial real estate valuation pressures moved higher from already stretched levels. So, and then kind of goes into farmland, with their farmland prices were also elevated relative to rents driven by rising crop prices and limited inventories of land, right? And one kind of comment I'd like to make that I've noticed they have done a few times throughout this throughout the report, and it kind of makes sense in terms of basically looking at rates and any form of rate of return for whichever market we're talking about, whether it be corporate bonds, any form of real estate with cap rates, dividend yields, that sort of thing. They always kind of look at the difference between them and real treasury yields. So it's kind of, when you look at that spread, it seems like it's always with respect to trying to understand kind of the risk premium investors are searching for, basically in order to enter that market or to deal in that market. And now granted, it's also like, it's kind of a more generalized approach. It's not necessarily, because if you have someone who's an absolute professional in like a very niche topic in real estate, it's almost like, no matter what kind of market's going on or what's happening, they can pretty much make a profit for the most part. But that's kind of more of a generalized concept. And looking at the difference between those returns and real treasury yields is rather interesting, kind of looking at a broad market perspective, it seems. But regardless, to look at the actual size of these asset markets. So not surprisingly, the largest is residential real estate at about 53 trillion as of right now. And this grew 16.8% year over year from Q2 2021 to 2022. And then the average growth rate from the 1997 to 2022 Q2 is 6.3%. So that's like what, 2.5 times the actual or the annualized average growth rate during that period. And so it kind of puts it in perspective. And I think, and we'll get into in the future, where basically I think this was the last time this growth rate was this high was in like mid 2008-ish or 2006, 2007, before everything started to come down during the GFC, right? Now that's not necessarily a looming sign in and of itself. With these markets, there's so many cross currents, you have to really look at multiple different points of view, I think, and then just kind of understanding all the different metrics and that sort of thing, right? And so then there's equities, which is at about 46.5 trillion. But this is the only asset market that actually decreased in size, according to their data, and it was at negative 15% over the past year, whereas the average annualized growth rate is 8.4%. And so I also think it's worth noting that, not very good at adding 15% of a not so even number off the top of my head, but still, the fact that equities were at least close to residential real estate, I think says a lot about the kind of American economy in general. I hesitate to say economy. I want to say more towards asset markets, because I think there is an important distinction there. Yes, they're related, but still. Just kind of thinking, looking at the demographics and how the American people are in terms of the kind of financial system, right? And how much more emphasis is placed on equities rather than in other foreign countries, to where most of it's in real estate, right? And that's more of a kind of a broad stroke of things. I think our broad stroke approach, because when you look at, say, you have to look at also the types of people who are in these types of, in these investments. I don't want to say investments necessarily, because I say it like that because it's like you have people who are, more of your, we'll say, lower middle class to maybe even middle class, to where they don't really have any type of equity portfolio, maybe besides kind of a corporate 401k or whatever their job is, right? And basically their entire net worth is in their house. And so you kind of expect to see residential real estate way up there. And I think the fact that equities are on par with that shows the amount of emphasis placed on the equity market in the American society that I don't think you see in other countries, right? So that being said, basically coming down in size to commercial real estate and treasuries are both around 23 trillion, somewhere in there. And I think it's noteworthy that this is less than half of residential real estate, again, showing how much emphasis is placed on housing, right? And those showed annualized growth rates of between 7 to 8%, just kind of rounding numbers. I will put this, obviously I'll put a link to the whole report itself in the description, just because citation. And the whole point is to share this information and kind of go over it and discuss it. So there's that. You can always find that kind of stuff. If I'm using any form of, if I'm citing any information from a report, I will always try to put the report in the description, just because I think you have to do that anyway. You can't just cite stuff, or can't just use information and not cite where you got it from, right? And so from there, it basically kind of goes to lesser things like investment grade, corporate bonds, farmland, junk bonds, leveraged loans, and so on, kind of just showing not much difference from the historical norms, right? Don't want to go through every single line item. But I guess the only other one that I'd like to go into is farmland, because I mentioned it before, to where this only has a kind of a total asset market value, or size I should say, of less than 3 trillion. Still, that's not like that's a very small number in kind of objective terms, but relative to the other markets, it's near the bottom, right? But what's interesting is it showed a annualized growth rate of 1.5%, as opposed to its average of 5. And so I'm curious to see why, especially noting that they also stated that farmland prices are, I think, historical highs. They were elevated relative to rents, and this is driven by rising crop prices and limited inventories of land, so kind of a supply shortage in a way. But just to keep in mind, right? And so I think I'm going to leave this one here, just to kind of keep things separate and neat and everything as we go through the reports. So with that being said, again, everything will be in the description. I'd love to hear you guys' comments and concerns. Basically, a lot of the next few videos going over this report are going to be related to kind of comparing not only from what we've seen over the past year, but other kind of more, I don't know if I'd say objective measurements, but at least broader in scope, like looking at like the liquidity metrics that you'd have for different markets like treasuries. We're going to go pretty in-depth with treasuries because that's such an important part of the monetary system. Without a deep liquid market in U.S. treasuries, then it's pretty much everything is done. I mean, I don't know if I'd say you'd have like a Mad Max scenario or something like that, but it's still, if you completely lose the treasury market, then you're looking at unprecedented events in general, just like because if you don't have that type of funding, and as we go through it more in depth, it'll kind of make more sense, right? And so we'll be looking at that and a lot of the nuances that I think are interesting and it's kind of necessary to understand in that type of market. But anyways, again, I'm going to leave this one here. So I hope you guys have a good night, and I will see you on the next one.